Welcome back, everyone. This week, most of your questions were around recession. Simon, should we sell our stocks before a recession? When does the recession start? Should we stay in the game? How much percent should we stay in the game? So let me share my recession portfolio. This is not financial advice. This is what I am doing because there will be a recession. That's 100% sure. 100%. The only thing we don't know is when is it coming. We are awaiting a recession since many years now. So it could be this year, it could be in 3 years, it could be in 5 years. I expect a recession to happen every decade. And I do not plan to time the market. So instead of timing the market, I prefer to have time in the market. What's the difference? Timing the market is probably arrogant because nobody can do that. If somebody tells you they can time the market, I would personally unsubscribe because they're lying to themselves or to you. Nobody can time the market, not even full-time traders. So if you cannot time the market, how can we beat the market? By staying in it with high-quality assets. So this is my strategy, and I'm sharing with you exactly what I'm doing. Let's jump into it, and I'm curious to hear what you are doing in the comments. So I've just started this survey on X, if you want to follow it, at Simon Severino. What's the best recession stock? And right now, you guys think Visa is the best one, followed by MSCI and Hermes. Meta got 0% votes so far. So let's see how this unfolds. I just started this a couple of minutes ago. So my plan, the headline is risk management, and this is the most important skill to cultivate when you're an investor. Risk management and capital allocation. So I'm studying the super investors since now a couple of years. I've read over 60 books on investing. This is what I am doing to manage my risk. First of all, I have a risk curve. So I'm always tracking my holdings in terms of high risk versus low risk, high opportunity, low opportunity. So what's the upside risk? What's the downside risk? And I have on the right side, highly speculative, high upside opportunities that have the highest risk. And on the left side, you have low risk, but also lower reward. So one thing to do is to have a look at your risk curve and make sure that the distribution on that risk curve is done in a way that if you are in a recession with your holdings, you still don't feel the urge to sell, because that's the whole point. If you keep them long enough and if they are high quality, they will go up over time. 10 years later, they're higher than now. Okay, Simon, but how do I know if they are higher quality? So let me share with you two things. One thing is the firm run well? Simon, I don't know if the firm is run well. I don't get a meeting with the CEO of that company. I hear you. You don't need a meeting. You can actually know more than talking to a CEO from running this analysis, which is looking at their operating margins. In fact, if you talk to a CEO, run this analysis before you talk to them, because after you talk to a CEO, you are always a little bit bullish. The reason why they are the CEO of the company is, first, they are bullish about that company, and second, they are very charming and very smart. Otherwise, they wouldn't be the CEO of that company. So they can influence people and they can influence how you think about the growth trajectory of that firm. That's why it's fine for me that I cannot talk directly to the CEO of Amazon, Kinsale, and BlackRock. I don't need to. I look at their performance and I look at, is the firm run well? That's operating margins. Is the firm able to generate cash flow higher than their current market valuation? That's free cash flow yield and forward free cash flow yield. Those are the things that I look at. And it's less emotional than talking to a CEO, because if I talk to that CEO, they can easily manipulate my perception into being much more bullish. So, is the firm run well? We look at operating margins here. And when we look at operating margins, we see very low margins with Amazon, Tesla, CCCS, even Ferrovial. But then we see here very good margins with Booking, Google, Kinsale, BlackRock. And from here on, we have some really, really solid margins. Look at Meta, Hermes, SBAC, MSCI, MasterCard, and Visa. When you are here in the 70%, 50%, 40% of operating margins, this tells you the firm is run well. Now, what does it mean for the future? Well, it means right now they are able to cost control. They are good capital allocators. They know how to take decisions. They know how to align everyone. So if they know how to do it now, that gives me a better sleep quality. In case of a recession, I know they will bounce back faster than others who are mismanaging. So is the firm run well is something that tells me in a recession, I want to own Visa, MasterCard, MSCI, SBAC, Hermes, Meta, Moody's, BlackRock, Kinsale, and Google, and Booking over all other opportunities that I have. So this is my first part of my answer to your question. Hope that helps. If not, ask even more in the comments. The second part, after I know that the firm is run well, I want to look at their ability to generate cash relative to their current price. So, forward free cash flow and free cash flow yield. When we look at the first question is, are they currently able to generate cash? Now you would say, well, I hope, right? That's the minimum that a firm should do. But if you screen the Fortune 500 for forward cash flow yield, you will be surprised about what you find. That's why I don't like to own a basket of all the top 500 companies, because 400 of them do not meet my criteria. 450 of them I don't want to own. 50 of them can pass my criteria, and of those 50, I want to own the top 15. Ideally the top 10, but then I don't sleep that well. So I undulate between 10, 15, 17 holdings. Let me know how many holdings you want to have in your portfolio. So 10 is obviously can perform better. 17, you sleep better. Somewhere in between is the ideal allocation, and we have to find the ideal allocation. So forward free cash flow yield is telling you, is the firm able to generate cash right now? That's the orange one here. Free cash flow yield. Let's look at the winners of this category here in the portfolio. We have Amazon, KKR really stand out. Kinsale Capital really stand out. Those are the top 3 in terms of free cash flow yield right now. So their ability to generate cash flow is very high. Now, let's look at forward free cash flow yield. What does the market, the analysts expect them to generate? Ideally, you want to have the forward free cash flow yield slightly higher than the current one, because that tells you future expectation. The winner here is the Italian C Group. They build mega yachts that are longer than 40 meters, so it's 50 meters, 70 meter yachts, which of course make them recession proof, because people who can afford yachts will not be touched that much by a recession, because they are mainly in assets, and assets don't go down that much, they rebound faster. So we have the Italian C Group as one of the companies that stands out here, but also BlackRock. And I'm often criticized for owning BlackRock. It's one of the biggest positions in my portfolio, and I love BlackRock for many reasons. Go to my video about BlackRock. I think I called it 1 trillion reasons to like this stock, because $1 trillion is their assets under management. And right now they're innovating. I'm very bullish Aladdin. It's becoming the standard in the industry. And look at BlackRock. This is the ideal proportion you want to have in terms of the gap between free cash flow and free cash flow yield now, which is here around 3%, and the free cash flow yield that's expected in the future, which is around 6%. So this is perfect. Also, if you look at Meta, if you look at Booking, this shows you stability. When it's currently free cash flow yield and forward cash flow yield are almost the same, that's telling you stability. That's what you want to have in a recession. But also having this huge gap up here tells you that there is growth potential. There might rebound faster in a recession, after a recession. Ferrovial is going in the right direction, SPAC is going in the right direction, MSCI, right direction, MasterCard, right direction, Visa, right direction. Why am I not surprised by this? Right after all the fundamental analysis that we looked at, it was clear also before looking at free cash flow yield that these companies are companies with a high quality. So, Simon, what should I do in a recession? This is my answer. I look at the quality of the assets and I buy assets and add to those positions where I find strong fundamentals. What's a strong fundamental? It's their ability to generate cash on their own. It's their ability to generate cash moving forward. And is the firm run well? That's their ability to allocate capital and to control costs. So if the firm is run well, like Visa, MasterCard, MSCI, SPAC, Hermes, Meta, Moody's, BlackRock, Kinsale, Google, and Booking.com, and even Salesforce, well then I don't have a problem holding that during a recession. Now, what is your plan? What are you going to do? And what are some assets that are in your portfolio, on your watch list? Let me know, and together we can be much smarter capital allocators and reach financial freedom faster. Keep rolling, everyone.